let's go through the biggest deductions you're going to have in your business. And we're going to go through this pretty fast to get the best bang for your buck. So if you love keeping money in your pocket, make sure you smash that like button, because it's going to tell the algorithm how important videos like this are for other businesses as well. So let's get right into this. The biggest deductions, and we're going to go this kind of fast over like the big common things like your electronics, your vehicles, and your meals. Your electronics, think about it from anything you're using in your business, anything that's hardware used in your business, whether it's even the softwares that you're using, any kind of subscription-based models, your cell phone, cell service, your camera, your vehicles. So there you get to choose between your actual expenses or your mileage. If you don't drive a lot, use actual. If you drive a lot, mileage. Pretty simple. Meals, if it's under $75, you don't need a receipt. Should you have one? Yes, you should. But you don't, even if it's under $75. If it's over, you definitely need a receipt, but you definitely need to keep a journal of what happened at that meal. Pretty simple. Again, we're not going to waste a lot of time on this. This is pretty basic stuff. We're going to have more advanced stuff. This way it's going to be more powerful than just like learning how to deduct the newest camera you bought. Let's go through the home office. Now, whether it's an external office, someplace you're renting, someplace you own, or it's your home office, these are all the things that you can deduct. Your utilities, your mortgage, your internet, your insurance, your repairs, your depreciation in your home, whatever percentage you're using in your home, you can deduct everything. Your coffee machine you put in your home office. Think about all the things that you can put in there, not just the big stuff, but all the things that you could use. Think of all the things you use in your house that you can just put in your office. That's it. You can deduct it. Pretty simple. Even maid or janitorial. And here we can think about how to use your kids in some kind of janitorial or maid service, which is basically just cleaning your office. Or shredding papers. So how was this done? This is done on a Form 8829, or you can do it as an accountable plan if you have an S Corp or a C Corp. We don't really focus on C corporations and teaching, just focus on the S Corp. That's an 1120S form, and that's a reimbursement that you give to the employee. You're the employee, you're gonna get reimbursed for the things in your house. There's the two ways you could do it. So how does this work as far as taking all these deductions? Again, you can take off things like real estate taxes. So how is this done? You take the percent size of your house, that's the common areas. So you can deduct things like staircases or things that are just not common areas, right? So you can deduct all of those parts of the house and focus on the actual common areas and then take a percent of the house. There's another way to do it too. You can take the average amount of rooms. The rooms have to be pretty close to the same size. So if your home office is one of 5 rooms, you can actually deduct 20% in that case. So when should you use this? When a large part of your house can be used for an office. When I say a large part, I'm just talking 10 to 25% of your home. If your home office is actually tiny, right, or it's not a big part of your home, if your home is huge and your home office is tiny, just use the square footage method, which is $5 a square foot. And it's just very simple math. And that's the other way to do it. But I'm trying to show you how to maximize your deductions, not just tell you home office deduction. I think all of you know that. Let's talk about your children, probably one of your biggest deductions you'll ever have. It's almost $13,000 a year in deductions that you can have by hiring your children in your business. And again, you can think about all the different ways your children could work. They could be janitorial work, helping you with your office. They can help you do video editing. They can help you do a lot of stuff in your business. How about modeling that you'll use in your marketing? Again, let your imagination work. As long as it is a legitimate business function, you can hire your children. You can deduct over $100,000 before they are the age of 18. As long as it's a legitimate business use, you can hire them for it. How about business trips? Yes, you can deduct a business trip. So think about some creative ways if you want to go to certain places and then have a business trip, let's say in the Bahamas or Florida, wherever you want to go. Think about how you can strategically do that, where you spend 2 days there for business, and then you can deduct a portion of your trip that's business related, and write it off. We're talking about hotels and meals. Everything that has to do with that business trip. And this is a very strategic way to start writing off things that can be a little fun and also at the same time can be a write-off for your business. But you can't write off entertainment that's been taken away. Don't do that. Let's talk about a huge way to wipe out basically your entire income if done strategically. And that's Section 179 and bonus depreciation. And here's how this could work. And literally, you can wipe out your entire income by doing this. Let's say you make $100,000 and you buy a big piece of equipment that costs $100,000. Now, of course, if you make $100 and you buy equipment for $100,000, you have no money. Who cares if you can deduct everything or have no income taxes if you have no money? But here's what you can do. You can finance the equipment, and then you can use Section 179 and bonus depreciation and literally depreciate the whole thing and pay $0 in taxes. I have a friend who did this and wiped out $200,000 in income. And guess also what he had? He also, by using his bonus depreciation, he could forward that loss, and he wiped out his income for multiple years. It's that powerful. How about employee outings? Believe it or not, you can go for picnics with them. You can go out to a restaurant. You can take them out as long as it's done in a way where it's going to be structured as an employee outing to help the morale of the business. It's not just for fun of the sun. It has to be very specifically, and it has to be infrequent. Let's go through qualified retirement plans, HSAs, HRAs. Now, a qualified retirement plan is something as simple as a 401k or an IRA. And again, you can write that off your income. Your income, you still have to pay self-employment tax. An HSA or an HRA is for your medical expenses. So if you have a high deductible health insurance plan, you can get an HSA and an HRA. They have some differences. I'm not going to go through that in detail, but they can pay for things that won't even be covered by insurance. Now, an HSA or HRA has one huge benefit, and that is you don't pay any tax, whether it's self-employment tax or income tax at all, putting the money in or taking the money out. Let's go through S corporation savings. Now, technically, this is not deductions. Some things are not deductions, like depreciation is not a deduction. It's depreciation. But again, these are the biggest write-offs you can have in your business. An S corporation, think of it either as an LLC or an S corporation. LLC taxed as an S corporation. It's called an S corporation election. What this does is it helps reduce your self-employment tax, which means if you're paying 15.3% on $100,000, you're going to pay $15,300. But let's say in this scenario, we take this and we look at it from this perspective. If we take that same $100,000, $50,000 goes to salary, $50,000 goes to distribution, you're going to save $7,650 every year doing that. Now, of course, we can play those numbers a little bit, but you get the idea. There's massive savings in an S corporation. That's why you want to work with companies like us. You can click on the link below. We'll be happy to help you. Trust me, this is very easy for us to implement in your business and then give you a great structure on how to do this. Now, I want to show you how you need to think through deductions. And this is very, very important because some people think I'm just going to buy more equipment, write off more stuff. But ask yourself this question. Do you need the equipment? Do you really need the write-off? Let's say that equipment costs $1,000. Well, sure, you're going to write off that $1,000. Boom, it's gone. But you're going to spend $1 to save 35 cents. Think, you're going to spend $1 to save 35 cents. Now, if you need the equipment, get it, write it off. It's great. But this is a way for you to think more strategically. You need to think, if I need the equipment, great. Let's say I made a lot of money that year and you want to start bringing in equipment. Great, do that. If it helps you expand, if it helps you grow. But just don't start buying stuff in your business to save on taxes, especially if it's going to cost you $1 to save 35 cents. Doesn't make sense. You lose money in most cases. That's why you need to think strategically. If you're going to start doing that, start putting your money in a thing like a qualified plan like we talked about earlier, or an HSA or an HRA. Those are better places to put that money versus buying stuff that you don't need. Was this helpful for you? Great. Click on the link in the description. We're happy to help you do this. Subscribe, like the video. It pushes this up the algorithm. I didn't want to give you the typical deductions that people say, like deduct cell phones. That's pretty obvious. I wanted to give you bigger things to deduct. There's a lot of things you can deduct. There's actually some really advanced strategies that you can do to maximize deductions. And if you want to learn more how you can save money on taxes, click on that video right there.